Hello everyone, this is Ben from Crypto Addicts. I hope you are doing well. You may have already watched our video in French or been on our Telegram channel, but today, to meet the request we have had, this is our very first video in English. Today we will talk about the 4 most important chartist figures to analyze. Here we go. You may have already thought to yourself, the graphs are beautiful, it's full of color, there are figures in them. It's maybe important. And the answer is yes, it's actually very important. Let's just recall the basics. There are several types of technical analysis. On one hand, there are the indicators that are subdivided into trend indicators such as the MACD, volatility such as Bullish, and momentum such as the stochastic. In addition to these indicators, there is the chartist analysis, which will analyze the figures that are reproduced in the price curves. These figures have a meaning, and it is a question of analyzing them as a representation of the psychology of traders, a battle between the sellers and the buyers, but above all a war of market sentiment. Ignoring them is obviously a bad idea because any analysis must be as complete as possible, but detecting them can sometimes be complicated. That's why we are going to go back to the basics of the pattern analysis in today's video by looking at the 4 main graphic figures to look at when you open your chart on TradingView. We will start with the configuration you have probably already heard about, is the head and shoulders. As its name suggests, imagine a line starting from an arm and following the outline of someone's chest. This configuration is one of the most accurate and trustworthy in the trading world, with more than 80% success once the figure is complete. This configuration signals in most cases, because remember that trading is a matter of statistics, a trend reversal. A head and shoulders normally forms at the end of a bullish trend and signals a weakening of demand from buyer versus sellers. As I told you, it's all about mass psychology. As you can see on this graph, prices form first a high point followed by another even higher point. So far, no problem. The trend is not questioned. The problems occur when the head forms a low that is no higher than the previous one and generally return to the level of the previous low. And then we'll talk about the neckline. In these figures, we then have the right shoulders, which form a top lower than the head, indicating that the buyers are losing power and that the pressure is getting stronger. And the figure is then validated when the right shoulders reach the neckline, which will very often lead to a downward price reversal. We have seen the case of a bearish turnaround, but the inverted head and shoulders also exist and materialize at the end of a bearish trend and often signals a bullish recovery. The second one is the bullish flag. The bullish flag is also a fairly reliable pattern. You may have already heard of a bevel or a pennant. Well, it's basically the same thing, the underlying psychology being pretty much the same. A bullish flag is formed when prices enter the consolidation phase after a bullish impulse. Consolidation occurs when, after large variation, the price gradually stabilizes by reducing its volatility. From a psychological point of view, we can imagine the force at work. During the formation of the flag, some take their profit after experiencing the growth of the bullish trend, and others accumulate, but the market mainly gains momentum before the next bullish explosion. We have an example of a bullish flag on these figures. From a statistical point of view, we know that the probability of this figure being confirmed is 87%, with often 3 ribbons on the flag supports. As for the head and shoulders, the flag also has its bearish counterpart, corresponding to a ribbon in the downward trend before a more significant fall. Let's now move on to the next figures, the cup with handle. This figure was first presented in William O'Neill's books How to Make Money in Stocks. This model of the cup with handle is a bullish chart model that is very well known in the classical stock market. but also seem to work quite well in the other markets. The difference, as far as the crypto market is concerned, is its duration. If in general we talk about a 6 months time frame on the classical market, it can easily be divided by 2 or even more in the crypto market. This figure is much rarer than the 2 previous one, but just as reliable, especially if we see an increase in the volume of exchange during the formation of the hype. The statistics speak about around 79% of chance of having it confirmed. Let us look at an example. We can see here an example of a cup and handle. The most conservative way to trade this pattern is to wait for the neck line to break. This line is located on the tops of high points formed by the figures. But be careful, it's often happens to have a pullback on this same line, so it's a question of being patient and being careful in the trade. As with the 2 previous ones, this configuration also has its opposite downward trend. Wouldn't you like a cutback? The 4th figure we will see today is the one of the rectangle. This is undoubtedly one of the most common configurations we encounter in the financial market because it is simply a trading range, or in other words, a rectangular area in which the price remains blocked and which occur following an upward impulse. The underlying psychology is exactly the same as for the flag, namely a catch of breath of the trend before an explosion. Here, the classical market statistics are generally in the 70% range, but on the crypto market, with the Bart Simpson we have known, here where a dump followed by a rectangle and then a pump frequently arrive, the statistics is probably closer to 60%. Then, there are several ways to trade a rectangle. We can trade the end, switch to buying when we are on the lower bounds to support in a way, and sell under the upper bounds, the resistance. We can use a stochastic indicator which works very well in range trading. You will see the accuracy of this indicator on this graph. The second strategy is that we can wait for the rectangle to break in the direction of the previous trend before positioning ourselves. Here we are already at the end of this first video in English. I hope you will now be less helpless when you open a graph. We will meet again in the next video in the coming weeks. I wish you a very good day. See you soon!